Something extraordinary is happening in financial markets right now, and almost nobody is calling it out. The MSCI World Index, which tracks global equities across 23 developed markets, is trading nearly 2% above where it was before this war began on February 28th. Let that sink in for a moment. 54 days of war, the largest energy supply disruption in history. The Strait of Hormuz still effectively closed. A U.S. naval blockade on Iranian ports. Iran seizing 2 container ships this morning, 2,000 vessels still trapped inside the Persian Gulf, and global stock markets are higher than before any of this started. This morning, Trump extended the ceasefire indefinitely. Iran responded by seizing 2 ships in the strait within hours. Oil jumped 3% back, above $100, and yet, equities shrug. Goldman Sachs explained the market logic this week. Investors are removing the worst-case scenarios from their calculations. No $200 oil, no total collapse of global trade, no world war, so markets are pricing relief rather than reality. But Goldman Sachs also said something the headlines missed. You cannot draw down global oil inventories forever. Every day the strait stays closed, the world consumes reserves that cannot be replaced until shipping normalizes, and the damage to refineries, terminals, and energy infrastructure across the Middle East will take years to repair regardless of when the war ends. CSIS, one of Washington's most respected strategic think tanks, published their assessment this week. This is a war of endurance, not firepower. Iran is leveraging the Strait of Hormuz to raise global costs while betting it can outlast American political will. That is exactly the Swiss perspective we have been sharing since the beginning of this conflict. Iran does not need to win militarily. It just needs to wait. Every week the strait stays closed costs the global economy billions. Every week oil stays above $100 drains consumer purchasing power across Europe and Asia. Every week the war continues erodes Trump's domestic approval ratings ahead of November midterm elections. Time is not America's ally here, and markets have not priced that in yet. For Switzerland, the disconnect between market prices and geopolitical reality creates a genuinely dangerous investment environment. Swiss pension funds that repositioned back into equities during the relief rally are now exposed to a market that is pricing optimism the facts do not support. The S&P cannot normalize policy while oil stays above $100. Swiss exporters cannot plan when energy costs remain this volatile. For Europe, the picture is equally uncomfortable. Goldman Sachs forecasts Brent crude at $80 by year-end. That is $20 permanently higher than before this war began, even in the best-case scenario. Even if the war ends tomorrow and the strait reopens next week, the damage is already priced into energy markets for the rest of 2026. Markets are above pre-war levels. The ceasefire was extended this morning and violated within hours. The Strait of Hormuz is still closed. From Switzerland, we watch this disconnect carefully, because in our experience, the gap between market prices and geopolitical reality always closes eventually, and it rarely closes in the direction markets are hoping for.